Right.
Okay, so today we welcome Alastair Mundy of Investec Asset Management to our offices. Welcome, Alastair. Alastair manages two of Investec's front-running funds, the Investec Cautious Managed Fund and the UK Special Situations Fund, which many of our clients hold. Intriguingly, you also hold title of Contrarian Investor investing at Investec Asset Management. It might be worth explaining a little bit more about what that actually means and your views on that.
Yeah, sure. Contrarian investing to us really means looking for out-of-favour stocks for ideas. So typically, we don't really look for to buy anything unless it's fallen at least 50% relative to the market. Typically, we're talking about stocks in the FTSE 350, and down 50% shorthand means you get on the 10 o'clock news. You might be a bank, a retailer, an oil company. You're really out of favour with investors. Why are we contrarian investors? Because we think it's very hard to get competitive advantage in fund management. We've all roughly the same intelligence. We've all got roughly the same amount of information. So to be able to say you're better at someone than doing some analysis is hard. What's our competitive advantage? We wait for other people to panic and to lose heart with their investments and to capitulate. And at that point, we come in and we say, why are they selling the shares? Are they thinking irrationally? Are they being irrationally pessimistic? And have we got an opportunity by being objective to see a reason why this share could bounce back from its place on the dump heap, really?
Right. Okay. So unloved. Much a story of the unloved stocks.
Absolutely.
Yeah.
We're asking for a company to go from being unloved to being average, and we don't think that's a lot to ask for. We think it's a lot harder to buy a stock when it's average and you want it to be brilliant, or even imagine buying a stock when it's an all-time high. You're buying it when it's brilliant and asking it to be even more brilliant in the future. We think we're at the low-risk part of its performance cycle.
Okay, so how's that sort of strategy bearing out at the moment then, in terms of, can you give us a couple of examples of the stocks?
Sure. I mean, we don't really worry about it bearing out at any particular points, but we think a long-term contrarian strategy has proven to be successful for investors. So we don't necessarily rely on one market rather than another market. It works in our experience in bull markets and bear markets. So the sort of stocks we buy at any particular time, and our holding period is about 5 years, depends on what's out of favour at any particular point. So 6-7 years ago it was large companies that were out of favour, 3 or 4 years ago it was companies more exposed to the economic cycle. So companies we've got on the portfolio at the moment, stocks such as Travis Perkins, the builder's merchant, Signet Jewellers, the jewellery retailer, and they're what we call quality cyclicals. These companies are definitely exposed to the economic cycle, but we think of very strong companies. They're market leaders, they've got good market shares, local monopolies, pricing powers, and if we can buy them when they're out of favour and look to ride the economic turbulence, we think that they're very cheap shares to hold for the longer term.
Great, okay. So in terms of the view in the market at the moment, that we're possibly in an era of sort of low growth for the next 5 years or so, do you conform to that, or what's your view on that?
Well, we don't really worry a great deal about the economic environment. A lot of our work is as bottom-up investors, looking at individual stocks. Because even if you know where the economy is going, it doesn't necessarily help you pick the right stocks. There's no textbook link. However, having said that, I think there is still so much debt in the world, particularly in the Western economies, that the economic history tells you to pay off that debt, we either need very slow growth or reasonably high inflation. That's the two ways that have worked historically. So I think to imagine that we're going to bounce back to previous high levels of economic growth would be a very optimistic scenario, and I think a too optimistic scenario to take as your core forecast.
Okay, excellent. Also, there's obviously you're running two very successful funds at the moment. One of which, the Cautious Managed Fund, is just gone over sort of 2 billion mark. Does that pose any issues to you in terms of the management of the fund?
No, not really. I mean, it is quite a large fund, but if you think about what we're doing across our funds, we're buying stocks and assets when they're out of favour, and we're selling them when they come back into favour. So it's a strategy that is very liquid, because we're always going against the market, really. So we're very confident that we can manage 2 billion and more comfortably. And if we did have any issues, we'd clearly have to consider closing the fund. But at the moment, it's never been an issue for us.
Excellent. And we also have to ask you, if you wouldn't have been a fund manager, what would you be doing?
I'm not very sure. I did actuarial science at university, but was incredibly bad at passing actuarial exams. So I probably have failed actuary is the second best.
Excellent. Okay, thanks for your time.
Thanks a lot.